Hi everyone, welcome to Kpler's September webinar. We are very happy to have you with us today. Before we jump on the topic, I would like to take a short moment to give you some news about the latest news at Kpler. First, since July, we've added olefins to our petrochemicals coverage. We now track the global moves of the following commodities. Spread the word, and if you or your colleagues would like to try these new sets of data, let us know. That was the first thing. Second thing, on the product side, we released yesterday a customizable dashboard in the terminal, and you had been many to ask for this, so it's now on for every commodity on the terminal. It offers you a direct view on your most used charts, and it's fully customizable. You can also share this dashboard with your colleagues, so have a look and feel free to send us your feedback. Lastly, I wanted to let you know that Kpler people will be speaking in upcoming big industry events. François Cazor, our CEO, will be speaking at FT Commodities in 2 weeks on the 28th of September. And tomorrow, Stéphane Guy, our head of business development, will be speaking at Gastech in a roundtable discussion, which focus will be automation, artificial intelligence, and cyber security. So if you attend those events, make sure you don't miss them. Thank you for your attention. It's now time to dig into today's topic. This webinar will be animated today by Alexandre Unlauer, Homayun Falakshahi, and Kevin Wright from Singapore. I will now hand over to my colleague Homayun. Homayun, floor is yours.
Thank you, Arthur, for the intro. So through this webinar today, we are aiming to give the latest update on the oil market, where we are right now, what's the current state of the market, what this means for the coming weeks and months. And actually, we have to say that we're a bit disappointed that we didn't do this webinar a week earlier, because our outlook for the short term is quite bearish, to be honest. And it would have helped to explain the roughly 10% fall in oil prices over the past week. So we built the presentation in 2 sections. We're going to delve down into both supply and demand outlooks. And a very short way of saying that is our title, so imbalance or imbalance, really reflects where we currently are. So the market balance looks extremely fragile with rebounding supply and weak demand signs. Arthur, if you can get to the first line, please. Before I get started on OPEC Plus, so I thought the left chart here on this slide would be quite interesting. It could give an interesting insight when it comes to assessing OPEC Plus strategy. So on the left chart, the top line shows you OPEC Plus market share of seaborne exports, and the bottom line shows you the same thing for 4 countries which have seen strong growth in output in recent years, namely the US, Brazil, Norway, and Guyana. Now, as you can see, the loss of market share from OPEC Plus is not a new phenomenon, and it's striking to see that the 4 other countries have grown their market share from just 2% back in 2013 to more than 15% now. Now, this market share battle is very important, as we will see in the coming slides, and especially with my colleague Alex Unlauer, who will look at these countries specifically. Now, if we take a look at supply now, look more specifically at OPEC Plus, what we see is that we are now off the lows of 2020 with a rebound that we've already seen over the past few weeks. So that's in the middle chart that you can see. So looking at pure supply and compliance from OPEC Plus, what's noteworthy is that exports have rebounded off the lows. Probably means that we reached the bottom in the month of July, again, as you can see in the middle chart. That this rebound was actually expected as part of the deal reached in April. The cut target for the whole of OPEC Plus was lowered from the 1st of August. So initially, the cut target was supposed to be down just 2 million barrels per day, so from 9.7 million barrels per day initially to 7.7 million barrels per day. But actually, Iraq and Nigeria had agreed to compensate for overproduction. So the new target starting from 1st of August, we think is more around 8.3 million barrels per day. Now, with the target being lower, naturally compliance improved. So we were at 93% compliance for OPEC Plus in regards with the deal in July, and now we believe we are at 103% for August. So just as a reminder, the way we calculate compliance is by looking at exports with a lag, and we also include variation in onshore storage. So we may not capture everything, especially refinery runs, but at least it gives a good proxy to production. Now, if you look at the right, you get the table and full detail looking at how much countries still have to cut or maybe to actually increase production in order to reach 100% compliance. And you get our compliance view on the right. Now, in part, thanks to these lower targets, some compliance numbers have gone through the roof. So, for example, you see around 180% for Saudi and 120% for Russia. The shortfall that you can see for Saudi, so around 1.7 million barrels per day, is basically the target, what the target was in terms of cuts for May and June. So even if Saudi adds this amount of production to the market, it will still be at around 100%. So working around this model suggests that Saudi Arabia can technically remain 100% compliant and still keep its oil revenues from exports steady, even if oil prices go down to around $29 to $30. So there's still some room for maneuver for Saudi Arabia. Now, looking at other countries' compliance from the so-called laggard group really improved lately. So whilst we were around 30–40% on average back in June, July, we're now at an average of 80%. So the countries I'm referring to are Algeria, Angola, Nigeria, Kazakhstan, and Iraq. Now, the last thing I wanted to highlight on this line is that there is a hitch actually that could undermine Saudi's and Russia's efforts to pressure off these laggard countries. And it's the very low compliance that we are seeing from the UAE and from Oman. Now, I'll leave Oman aside as it's still a relatively small producer. But the UAE is something that has been quite striking to us. We've noticed this for a long time, actually, even under the previous OPEC Plus deals, but it only seems to have caught the wider attention just now in the month of August. Official numbers from the Minister of Energy himself suggest that there's only a shortfall of 100 kbd, but we see much more than that. We see even actually more exports than the UAE reports production. Now, this will be key to watch. What will be the reaction from other countries, from laggard countries such as Iraq or Nigeria, and others if they are pressured to cut more as oil prices fall, and if the UAE isn't pressured the same way. Now, this brings me to focus on a specific country, and it's Iraq. After, if you please get to the next slide. There's been mounting pressure from Saudi Arabia and Russia to push Iraq to cut more and to compensate for overproduction over the May-June period. Now, this pressure doesn't seem to get off, as a recent quote from the oil minister in Iraq suggests, where he said that his Saudi counterpart regularly calls him to urge towards more compliance. Now, the situation in Iraq seems to be improving, even just not specifically speaking about the oil market, but the country was in the middle of this path between the US and Iran in January, and in a huge political and economic crisis. While the problems have not gone away, the situation on the ground has at least calmed down to an extent, with the new prime minister so far showing a very good degree of independence towards both the US on one side and Iran on the other. Now, this could explain why country's compliance has improved, as you can see on the chart. So here it's an assumption of it's a view of Iraq's compliance to its cut targets. Right now, we are we're around 62%, But this is a big improvement. We were just about 25% just 2 months ago. Now, there's a few points that I think are worth mentioning here. The first one is that if you look at this chart, Iraq cut its exports the most last winter and during this summer. And I think this could coincide with the import of Iranian gas. Now, you may not sit directly in between the two, but I'll try to explain. So Iraq has 2 contracts to import up to 2 billion cubic feet a day of Iranian gas, although imports over the past few years have averaged between 700 million cubic feet a day and 1.3 billion cubic feet a day. Now, what's interesting is that there is a seasonal demand that could play a role here. Iran's gas, so not Iraq, Iran's gas demand skyrockets typically in the winter. And this actually happened last year again. And in addition to other internal issues, Iran had to cut exports to Iraq for a few days or even a few weeks last winter. Now, this probably boosted crude burn and fuel oil demand in Iraq, meaning that there was less oil available for exports. Secondly, Iraq's own power demand skyrockets in the summer. And despite Iranian gas imports, the country, Iraq, may have had to cut exports in order to use more crude internally, again, either directly as burning crude oil for power or as fuel oil. Now, obviously, we know that the OPEC Plus deal looks at production, but I think that looking at exports and inventories probably makes more sense to the market here, to what impacts the market. Now, 2 more things about Iraq. 90% of its exports take place out of Basra, and that makes the country particularly vulnerable to weather conditions around the ports, and the weather hasn't been great there lately. And finally, the central government is also struggling to keep a track of production in the north, in the Kurdish region, the KRG, and we think that KRG production has not really decreased since April. There's still around 400,000 barrels a day, including production from northern Kirkuk field as well. So I'll say, if you please get to the next slide, the summary to this OPEC Plus section. Here you can see what you can see right now is the variation in exports from OPEC Plus countries in August. So here specifically looking at seaborne exports. I think it's quite striking to see that on one side you have Saudi Arabia and Russia with the increase in exports in the month of August, and on the other, as you can see, you have both Iraq and Nigeria. Now, actually, I also highlighted Iran. Iran also, we think, has seen a big increase in its exports lately. It's quite interesting too, even though the country is not part of the OPEC Plus deal, but it shows that it's still able to export relatively important amounts, mostly to China. Now, based on our view of compliance and the fact that Saudi Arabia recently lowered its OSPs, we should expect the market share battle to take place, particularly towards East Asia. Now, we're going to have a fuller picture with Alex, my colleague, looking at non-OPEC supply. But I think what this means is that we should expect more supply coming out from Saudi Arabia and Russia, but the balance within OPEC Plus is going to be extremely hard to manage especially because of low compliance from the UAE. And I think the only thing that we're quite certain about is that the world right now cannot afford loads of new supply coming to the market just yet. Alex, your turn. There you go.
Yeah, thanks, Humayun. So if we start on shale oil, as usual, a lot of volatility in the industry. So let's see what are the latest trend on that sector. So as you can see, after a sharp decrease of production and therefore export, it looks that there is a rebound for the sector. So we see clearly 2 factors which explain that rebound, that recovery. The first one, of course, is driven by the oil price. So all the time we see WTI close to $40 a barrel, which has been historically a catalyst for US shale players. We see that there is a kind of ramp up in terms of production. So that has been the first reason. And the second one, which has been massive again during that oil price decrease earlier this year, is the ability for the players to decrease costs by 10 to 20%. And it has even been usually more, 20%, especially for the players in the Permian Basin. So where does that cost decrease coming from? According to what we heard during the Q2 earnings season from oil companies, it's mainly driven by deflation rather than by efficiency. So nearly 70% of the explanation of cost decrease is coming from deflation of oil services, especially on fracking. So that means that completion of a well is currently quite cheap. Also because you know that the wells that are completed right now is coming from the drilled but uncompleted well, meaning that you have only to frack the well and no need to spend money on drilling. As a reminder, right now in the Permian Basin, you still have 12 months of inventories in terms of uncompleted wells. So there is no need in the Permian Basin to drill in the next 12 months to keep production stable and even increase production. Of course, there is all the time drilling, but if you have uncompleted well, you don't need to spend more money here. So basically, a low completion cost supported the industry. That will be the case, I think, for the next 12 months. But it's true that in the medium term, that deflation is negative for the oil sector, not only for oil services, but for the oil sectors. And you probably saw earlier this week that Schlumberger, which has been a historical player on the US shale, sold his fracking division to Liberty, basically because there is no money that can be done on the division. So that means that it looks impossible to have a huge rebound in the next 2 or 3 years on the US shale oil because the oil services company has been destroyed by the latest oil price decrease from March to May in the US. But as said, in the short term, positive signal, and there is even an acceleration, at least on the drilling permits. But that could be linked more on the US election, as the drilling permits are more focused on the federal land than on the private land. So as you can see on the chart, we split the US export by in 3 categories. The one we're looking for is the blue one, which is a US shale grade. So it increased since the bottom in April, but was still lower than what we had in the first quarter. And it's true that in August there has been a small decrease, but not only on the US shale grade, but on all US oil production. And of course, that is explained, as you can see on the next slide, by the Hurricane Laura, which impacted not only crude oil, but of course also clean product and the LNG. So on the oil side, we lost nearly 0.6 million barrels per day as Houston and Lake Charles has been hit by the hurricane. It bottomed out since, and we should see a recovery actually on oil and clean product, but we're not sure that on the LNG there will be a huge rebound because Lake Charles was more impacted than the other one, and that hit more Cameron as an equity player. So there has been already some issue, of course, on the US LNG because the demand was quite weak. There has been a lot of cancellation for the last 3 months. A recovery was expected, so it's probably happening, but in a much lesser extent than what we had in mind a couple of weeks ago. As a reminder, we were at 1.9 million tons LNG exports in July, which has been a low point for the last since the beginning of the year in the US. It's also interesting just to mention that when there is a hurricane, for us it's quite easy to follow what's going on our platform. We can see who are the vessels that could be hit, the terminals, etc., etc. So we are able to monitor the impact on the hurricane on real time thanks to our platform. And right now we are on that hurricane season, so it makes sense to have a look on the platform. Finally, if we move on what was expected on the next slide, the most promising growth for a decade in the offshore. You can see that the picture is a little bit different. So here I'm speaking about Brazil, Norway, and Guyana. So all three countries are down in terms of exports by 0.5 million barrels per day. So it's down compared to December, 0.5 million barrels per day. But it's even down 1 million barrels per day if we compare to the high point in April. So Guyana is the only country which is up 0.1 million barrels per day, but it's a bit lower than expected, and that has been driven by gas injection issue with the production which was at a year low in July. So that's one part of the explanation. In the next 12 months or next 2 years, there could be also some delay on the production increase, and that has been driven by delay on government approval, because as you know, there has been some post-election power struggle that finally has been resolved last month, but we saw some delay on approval of project this summer in Guyana. On the positive side, there has been another discovery on the offshore at Red Tail that could add 8 billion barrels of gross discovered recoverable resources. So all in all, there is still a lot of potential. It has been the 18th discovery so far in the country. So a lot of potential in the country, but more in the 5 to 10 years than in the next 12 months. On Brazil, so in Brazil, export came down 0.3 million barrels per day. That has been driven by two factors. The first is COVID. There has been some issue on platforms where the workers had to stop. So that has been an issue. And second, as you know, Brazil was part of the OPEC Plus agreement. So they were willing to cut production and export by 0.2 million barrels per day. Interesting to focus on two fields in Brazil. Lula, which is still the main field, with production and exports above 1 million barrels per day. So that's what we can see on the platform. Of course, you can see the exports split by grade. Here we just highlighted the three countries. So Lula is very interesting to focus because it's the biggest, and it's a key play for Petrobras. But more interestingly, Buzios is the one which has the best trend in terms of production increase. It could be the largest field offshore by 2030. And right now, the export, so the production is at 0.7 million barrels per day. So at one time, in the next 2 or 3 years, it should be above Lula. And that's very interesting, again, in terms of equity, if you want to follow to track the players that are in Brazil. Last, for Norway, with Johan Sverdrup, which has been the key driver of that increase. We can see at the bottom of the chart. Actually, the ramp up of Johan Sverdrup was very quick, and by the end of last year. But since there has been quite an instability in terms of production, and right now even production is lower than what we had in the last quarter of last year. So all in all, there was a big expectation this year for offshore players, especially in the three countries. We could see some production increase, especially in Brazil, still this year, but the potential is more for the next 5 years. So we covered in the first part of the presentation all what's the link to the supply side of the market, and now my colleague Kevin will focus more on the demand side.
Thank you very much, Alex. As Alex mentioned there, we've very much focused on OPEC compliance. We've looked at the US, we've looked at generally the supply side of the coin. And in this second part of the presentation today, we're going to look at demand, we're going to look at inventories, and we're going to look at product exports and also some specific markets around the region that really have shown us an interesting story. So first of all, looking at inventories, we can see on this chart, onshore inventories are shown by the light blue bars and floating storage is shown by the orange line. Now, looking at onshore inventories first, we can see that they have grown significantly over the course of the first 8-9 months of this year. We actually reached a peak of just over 3.65 billion barrels in June. That's up by over 300 million barrels from the start of the year, so a significant growth on that side of things. At the same time, floating storage has also grown very, very strongly from around 90 million barrels at the start of the year to over 200 million barrels of floating storage, again peaking in June. Now, the interesting thing to note is that both of these numbers have actually subsequently fallen. Inventories are down by about 50 million barrels and floating storage is down by about 25 million barrels. So some floating storage tankers have been discharged, the oil has gone onshore, but it hasn't really increased the amount of product, or the amount of crude rather, in those inventories. What we've seen instead has been a stabilization of those positions. And what that means to us effectively is that the balance of supply and demand has narrowed. And that specifically refers to the supply of marginal or discretionary crude. So we looked at shale, for example, which has fallen this year from 13 million barrels per day of production in January to under 10, in fact 9.7 million barrels per day of production in the last couple of weeks, as reported by the EIA. Now, obviously, we have another very important factor to consider, and that's that next week there will be a meeting of the OPEC Joint Committee to decide their direction for the next few months in terms of cuts, in terms of extending cuts or reducing cuts. And clearly, with the market very, very finely balanced, that is a significant threat to that balanced situation. At the same time, and we will look at this in subsequent slides, COVID-19 continues to weigh on demand. I think there was an expectation around the world in a lot of countries that by now we would start to see some sort of normalization of behavior and therefore demand, and that's not really been the case so far. So clearly the supply and demand balance remains very, very fine. Moving on to the next slide. This is a chart showing clean product exports year on year. So really trying to get an idea of the annual and seasonal trends, looking at 2020 versus 2019. And the first thing to note on this chart is that in April and May, while refineries were still running fairly hard in East Asia, Japan, Korea, Taiwan, and China, we saw significant clean product exports. We actually saw higher clean product exports than last year, than April 2019. That carried on into May, but once we get into, that carried on into May from an East Asian perspective, but around the world, clean product exports actually fell. Now, once we got into June, we can see that those exports from East Asia that were really maintaining the balance disappeared. And we went into a significant deficit year on year versus 2019 of 7.3 million barrels per day of lower clean product exports. Now, it's important to note that over the second quarter of the year, the East Asian countries that we mentioned earlier, China, South Korea, Japan, and Taiwan, actually reduced their level of importation for gasoline and diesel in particular. Naphtha imports remained relatively strong, and that was really to do with the production of polypropylene for personal protective equipment for healthcare users. At the same time, as the reduction in imports, we know that refineries around the region were running hard. So domestic inventories were actually running up to significant levels, which resulted in basically no need for additional product imports in those three main countries. Now moving on to look at our next slide. And this is really, this is a slide designed to look at the impact of COVID and the impact of the measures that have been taken against the pandemic across the region. And we've focused really on three key economies within Southeast Asia. And this is really intended as a reference. So various countries around the world have had various different approaches to COVID and have had various different outcomes and results and so on. So what we're trying to do here is give an example that can perhaps be interpolated for other places. So if we look at the specific countries that we highlighted, the Philippines first. Now imports were hit specifically. Philippines is the orange line, I should point out. Imports were hit very, very hard in March and into April and even into May. Imports had actually fallen by 37% between March and May as a result of a very severe lockdown. The Philippines has seen the highest number of COVID cases in Southeast Asia, and the response from the government there was very strong. Now, we saw some recovery into July, but the reimposition of lockdown has affected August demand as a cluster was identified in Manila, and those measures have come back in. And it's going to be interesting to observe what happens going into September if that lockdown continues, because clearly the trend to the right-hand side of this chart is for a reduction in imports. Looking secondly at the blue line, which is Vietnamese imports, Vietnam was exemplary as a first responder, if you like. Now, Vietnam has history, if you like, or experience of dealing with respiratory syndrome. It was the first country back in 2003 to have a case of SARS outside China. And its luck didn't change this year. It was the first country outside China to register a case of COVID. And as a result, their response was swift, robust, and fairly severe. Military on the streets imposing curfews and so on. Now, what that meant was a severe restriction of industrial activity and personal mobility. As a result, product imports fell by 42% between January and March and started to recover in May. And you can see that that recovery was pretty strong. The reason for that? Well, because the lockdown had been so severe, Vietnam actually dealt with its pandemic very quickly and very effectively and was able to start opening up the economy. And we saw that sort of continue into May and into June. However, a cluster was identified in July in Da Nang. And Da Nang, as many of you will know, is very much a tourist center for Vietnamese as well as international travelers. So the cases in Da Nang were then spread to other parts of the country, and a partial lockdown has been reimposed. And we see the impacts of that on demand and therefore import figures falling into August. Thailand, we haven't covered on this chart, simply because it was relatively stable. The main thing that we saw with Thailand was naphtha demand remained relatively strong, all around petrochemical activity. So again, production of personal protective equipment and other plastics. Indonesia, however, the green chart is a slightly different case. Now, the demand was hit later on. We can still see that demand was high imports were very high in March and into April. However, they came down into May. And the reason for this was the government in Jakarta decided on a delayed and only partial lockdown. Now, that meant that industrial activity and personal mobility transportation were able to continue at normal-ish levels. However, as cases started to climb, and Indonesia is the second highest number of cases in Southeast Asia behind the Philippines, the government had to take more action. And we've seen that into July and also, into August. The government was planning to really open up the economy fully by late July and into early August, and that hasn't been able to happen simply because the number of cases continues to rise. Looking at my next chart, we turn to Chinese onshore inventories, and we can see very clearly on the right-hand side that the inventories onshore have grown very, very significantly this year, up by 150 or so, 160 million barrels over the course of the last 8 months. And we've reached 890 million barrels of crude in storage in August. Now, as we know, an awful lot of that increase in inventory was around opportunistic buying. In March, April, and May, the state purchased a huge volume of oil from the Middle East and other places in order to store. It was all around flat price. It was all around cheap oil being available. As a result, we saw, as I say, inventories reach 890 million barrels, and about 50% of that inventory is actually held within the Strategic Petroleum Reserve, the balance being split between commercial and refining stocks. Now, obviously, with a high volume that's been purchased, some of that crude rather, couldn't be discharged. So we saw an increase in floating storage. And as we see on the bottom chart, Chinese floating storage, or floating storage in Chinese waters, I should say, climbed to around 90 million barrels by August of this year. That led to significant congestion. By the time we got to August, it was around 14 days of waiting time for vessels to get onto the berth to discharge. It's now fallen to around 10 days on average, but some ports in Shandong and in Dalian are still seeing in excess of 20 days for vessels to be able to discharge. So clearly, the impact of that Chinese procurement on freight is not to be ignored. Moving on to the next slide. And just looking at the distribution of that storage within the Chinese commercial sector. So this is non-SPR onshore oil inventories. And the first thing to note is that more than 50% of the installations have less than 3 million barrels of capacity remaining as of August. It should be noted, this chart is designed to compare April with August positions. Now, I want to sort of highlight four main changes that I think are very significant. The first one of these is at Henley Refinery, which has seen a reduction in its available capacity by 7.5 million barrels. Simple reason for that is that Henley was given an importation quota, or a revised import quota, by the Chinese government, and as a result was able to increase the amount of crude it held in storage, and therefore the available capacity has gone down. Dalian, as a region, has seen a reduction in capacity, in available capacity of 10 million barrels, whilst it went through a maintenance program. Now, obviously, Dalian is one of the big refining centers in China, and a lot of those vessels that I mentioned a few moments ago were waiting to discharge in Dalian. As a result, we've seen inventories rise and we've seen available capacity go down. The third one on the reduction side is Weifang Refinery. And this is an interesting case, simply because Weifang has been given the green light by the Shanghai Futures Exchange to become a delivery location for the crude contract. And as a result, we've seen crude going into tank in Weifang. Something like 6 million barrels of inventory have actually been filled by that crude. On the other side, and worth highlighting here, the big sort of swinger in terms of capacity changes, Mercurius storage. Now, Mercurius capacity has actually increased over the course of the last several months by something around 10.6 million barrels per day. Now, some of that capacity has been filled, but we still see that the available capacity of Mercurius storage has gone up by 6 million barrels in total. So if we move on to our next slide. And really to highlight the key messages from the two halves of our presentation today. We've seen that global supply is rebounding and exports are up slightly over the past 2 months. OPEC Plus exports have increased by close to 1 million barrels as Saudi, Russia and others loosen restrictions. And obviously, as I mentioned, we will see what the outcome of the meeting next week will be in terms of where compliance goes in September. US seaborne oil exports managed to show signs of recovery, largely thanks to higher oil prices. WTI around $40 per barrel allowed a lot of shale players to increase production. In the very short term, the trend should continue therefore, but there are more uncertainties for the next 2 years. And finally, on the supply side of our presentation, 3 large non-OPEC producers, i.e. Guyana, Brazil and Norway, are expected to contribute the most to offshore production in the decade. But they delivered much lower production than was originally planned. August exports, as noted, finished at a year-to-date low. Now, on the other side of the presentation, on the other side of the argument around demand, we see that demand has improved off record low levels earlier in the summer as onshore inventories hold steady. And that's despite a drawdown in floating storage volumes. So we've got that stability, we've got that stabilization of the balance. Now, product exports, which showed positive momentum in July, have since backed off, although loadings remain less negative on a year-on-year basis when compared against the year-to-date until June. Product demand in Southeast Asia, as I mentioned just a few moments ago, has reduced as new daily case counts rise. So COVID is still very much with us, and lockdowns have been reimposed in some of those countries. China continues to deal with far too much oil purchased in the year. I mentioned the floating storage, I mentioned the congestion. Floating storage remains near 90 million barrels, which is a record, as onshore inventories built for a fourth straight month, and they're up 145 million barrels since the start of the year. And finally, additional Chinese SPR inventory space is holding near 150 million barrels, or 77% utilization, with large gains taking place. Now, at that point, I'm going to hand back to Arthur, and we can move on to the Q&A section.
Oh, thank you very much, Kevin. Indeed, we have a few questions here. The first one regards Kurdistan. I'm going to read that question now. Is the main reason for the difficulty of Iraq to bring down their production, the Kurdish region's high production, or is it more because of their contracts with producers? Humayun, would you answer this question?
Yes, sure. So question about Iraq and the Kurdistan region of Iraq. So looking at Iraq specifically, the Kurdistan region is, I would say, obviously it's significant, but it's not so much significant to the whole country, to the whole country's output. Generally speaking, the output from the region is a bit less than 10% compared to the whole country. So even though I think that the actual efforts by the region, the Kurdish region, to cut haven't been really successful, we can't say that we have seen big cuts, or at least even any cuts from the north of Iraq. But I don't think that you can solely say that it's because of this region that Iraq's compliance is relatively low. Just to say that in the coming months, I would expect compliance from the northern region, so from Kurdistan region, to be better, but mostly because of geological, I would say, reasons rather than political reasons, simply with the fact that production will be naturally declining at fields such as Tawke in the north, operated by DNO, and Shaikan, operated by Gulf Keystone. It's also worth noting that the companies present in the region are very small companies, or compared to the south. So companies like DNO, Gulf Keystone, Genel Energy, and the asset value that they have in the region is very important to them. So they would not be keen to cut production, while in the south it would be a bit more easier to do. But it also has to do with the terms of the contracts as well. It's also a good point.
Thank you, Humayun. Kevin, this question is for you. Why is there a stark decline from June to July onshore crude storage? Did refiners ramp up runs?
Well, the first thing that I would say is that, I mean, the decline wasn't really that stark. We're talking about a drop of about 50 million barrels between June and August, including July. So 50 million barrels on 3.65 billion in total is relatively limited. But I think one of the main factors that we saw was back in June and July, we saw a significant increase in the OPEC compliance. Therefore, there was less oil on water, less oil floating around. And as a result, even though refiners hadn't really ramped up runs at that time, the amount of oil going into tank had come down. So given that demand hadn't gone up, but supply had come down slightly, that really explains why we saw a decline from June to July.
Thank you very much, Kevin. We'll need to stop the webinar here. We will try as much as possible to send the answers to the questions that could not be answered today. Thank you very much for your participation. Thank you again. And there will be a second session of this webinar this afternoon. And we are always happy to have you with us for these sessions. Thank you very much and have a good weekend all. Goodbye.